Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. It's the 2nd of June 2023 and here are the top stories for the day. Indian banks are on a roll. The cumulative profit of government banks has soared 57% in FY23 from the last fiscal to breach the 1 trillion rupee mark. The net profit of private lenders has shot up by 23% year on year. The bad loan burden, which had kept them down for nearly a decade, has also lightened. But amidst all this, the regulator is advising caution. RBI Governor Shaktikanta Das has warned banks against hiding stress and has pointed to gaps in governance in certain banks. So why is the governor worried? Well, you can bank on Bhaswar Kumar to get to the answers.
It was the best of times, it was the worst of times. This famous line by Charles Dickens could prove to be an apt description of the situation the Indian banking sector finds itself in at present. The cumulative profit raked in by public sector banks crossed the 1 trillion rupee mark in FY23, thanks to higher interest income and improved management of non-performing assets. The State Bank of India alone accounted for close to half of the total earnings. Compared to 2021-22, the 12 PSBs witnessed an almost 60% increase in total profit, which touched 1.04 trillion rupees in 2022-23. The 14 listed private sector banks saw their net profit decline almost 10% year-on-year in Q4. It was dragged down by Axis Bank, which posted losses due to its one-time hefty charge for the acquisition of Citibank India's consumer business. But for the full year FY23, the net profit clocked by these private lenders rose about 23% year-on-year to 1.17 trillion rupees. Meanwhile, the net interest income of private sector banks rose almost 25% year-on-year to 2.84 trillion rupees in FY23, reflecting how they have benefited from the spike in lending rates. In April, the RBI Monetary Policy Committee pressed the pause button after hiking the repo rate by 250 basis points since May 2022, leaving the policy rate unchanged at 6.5%. Clearly, their profit figures soared on the back of higher net interest income and robust loan growth. There was a lag on the part of banks in passing off increased rates of interest to depositors while pushing the lending rates higher. This translated into an impressive growth in the margins of these lenders. In another indication of good health, at the end of 2022, the gross non-performing assets ratio of banks in India fell to 4.41%, which was the lowest since March 2015. This ratio stood at 5.8% at the end of March 2022 and 7.3% the year before. Nonetheless, on May 29th, RBI Governor Shaktikanta Das cautioned banks against aggressive growth strategies and the evergreening of loans. The governor said some banks were found to be resorting to innovative ways of concealing the status of their loans. He added that when the method of evergreening was pointed out, it was replaced by another. Das also expressed concern that despite the RBI's guidelines on corporate governance, it had come across gaps at certain banks. While these gaps had been mitigated, Das cautioned that it was necessary for bank boards and management to not allow them to creep in. So, why is the governor worried? And what steps is the RBI taking?
If you go back to Shaktikanta Das's statement, you will see that he is talking about also looking at the business model of banks. So regulator does not normally do this, but he is doing it. Reserve Bank of India is keeping a very close watch. In fact, it keeps it's not in public domain, but it keeps a heat map. And it sees that which bank has problem where. It's an immediate red flag and it reaches out to the bank and it even intervenes at the board. Overarching theme is the governance. That's the concern, and these are all business related issues like evergreening, which is still not stopped. All of us thought that after this one of its kind asset quality review in 2016-17. After that, the banks have come out clean, but not all banks.
The evergreening of loans, in which banks artificially keep the loan classification standard, was one of the reasons for the sharp surge in non-performing assets in the previous decade. On a separate note, at present, banks have more retail loans on their balance sheets than corporate loans. Against this backdrop, could banks see an increase in NPAs once again?
Yes, I could see some NPA problems. In fact, it's not in public domain again. Banks would not probably admit it till it becomes a reality. But there is certain cracks in the retail segment. My understanding is this: a part of the retail, not a huge part, but some retail loans are slipping into SMA and SMA1, and it's a question of time before they become actually NPA. So while the corporate credit book is pretty good, solid, but in the retail credit book, there are certain cracks which would surface soon.
The banking sector could also face other challenges going ahead. In February, Fitch Ratings said that the net interest margins of Indian banks were likely to face pressure in FY24 due to an increase in deposit rates to attract funds to support sustained high loan growth. The average margins are expected to contract by 10 basis points to 3.45% in FY24. Also, while banks saw their loan books grow 15% in FY23, bank deposit growth didn't even hit double digits, thus falling 2 trillion rupees behind the expansion in credit. Against this backdrop, will banks in India face challenges going ahead?
The lending transmission has happened much earlier. So the banking system has started, or the lenders have started collecting, higher rates from the borrowers, but the deposit rates are now growing. So the transmission is now happening at this stage. That during that in-between period, the banking system enjoyed a huge positive NIM, but now that will come under pressure because they can raise the deposits only at a higher rate. There are numbers which are now saying that the best part of quality of books is perhaps getting over. It's coming to an end. It may not have come to an end, but it will soon come to an end.
To sum up, the banking sector may appear to be in the pink of health, but the cycle of falling NPAs may be coming to an end, and pressure on net interest margins is expected. Against this backdrop, Governor Das's words stand out. Risks often get overlooked or forgotten when things are going well.
She's working her way to the corner office. Business Standard.
While Indian banks are on a roll, startups, it seems, have run out of steam. The streak of bad luck, which started in the second half of 2022, continues. Funding for domestic startups fell 75% year-on-year in the first quarter of calendar year 2023. So why are foreign investors circumspect, and what can startups do to convince them to loosen the purse strings and release the dry powder? Tariq Ahmed has the answer.
आज भारत में करीब 60 यूनिकॉर्न्स हैं। इनमें से 21 यूनिकॉर्न्स तो बीते कुछ महीनों में ही बने हैं।
Well, that was Prime Minister Narendra Modi about a year ago. How realities change within a single year. India's startup ecosystem looks very different now. We haven't seen a single unicorn take flight this year. Funding has dried, and most startups are struggling to stay afloat, laying off employees in hordes. The great Indian startup party reached its climax during 2020-2021 and lasted till the first half of 2022. In fact, in 2021, we minted a new unicorn every week. Venture capital firms pumped $38.5 billion into Indian startups that year. But the tide started turning in 2022. And this year, foreign investment in India's startups has plummeted 72% to $4.58 billion so far, from $16.2 billion during the same period last year. Foreign firms such as Tiger Global, Sequoia, SoftBank, Accel and Y Combinator have nearly shut their taps. Lion's share of funding used to come from them. Foreign VC funds play a crucial role in startup funding in India. Out of the $26.8 billion that Indian startups raised in 2022, $26 billion came from the rounds where foreign VCs participated. Tiger Global, which backed successful startups like Flipkart, Ola, Zomato, and 37 other unicorns in India, did the biggest cut in the investment. Its funding fell by 97%. Sequoia Capital's VC funds in India were reduced by 95%. SoftBank and Axel also did a significant cut in VC funds for India. To make matters worse, investments from Indian VC firms have also diminished, from $12.3 billion last May to $1.7 billion this May. But exactly why has foreign funding dropped?
By the way, majority of the funding to Indian startups come from US money. And then the interest rates of US yield were very low. And because of that, there was a lot of cheap money that was being flooded into the market. And then all that cheap money basically went into venture capitalists that eventually funded the Indian startups. Now, what has happened is because the interest rates have gone up, a lot of that money has dried up. Right. And hence, even VCs are now finding it very hard to raise funding, which will eventually come to the Indian startups. That is number one. The second external reason on which we don't have really too much control is inflation as a whole has gone up drastically across the world. Right. And so many changes have happened because of the Ukraine war and so on and so forth. Now, because of that, the input costs have gone up. And the moment input costs go up, obviously the costs of services go up, and then the startups do not have enough leverage in terms of margins.
And what about the business model? How sustainable is it?
Yes, India has 1 billion population, but then the actual market, if you think about it, especially for internet-based startups, is not more than 100 million. Right? So if you think about it, all these different startups, starting from Byju's to Zomato to Swiggy and all these guys, are all running after the same 100 million people. And hence competition goes up. And because of that, customer acquisition costs go up. And hence, right, you will see that none of these companies have any profitability to talk about. Now, the second reason is that there has been, I'm pretty sure, people have been following the disastrous IPOs of Paytm, Zomato, and Nykaa. Right, they came in with a lot of fanfare onto the stock market, and then now their investors have lost thousands and thousands of crores. Now, because of that, now there is a reality check in the sense that, oh, so the valuations that these startups command are actually not true. And because of that, many people are now saying, hey, wait a minute, these guys are not making any money. And hence, if we invest in these companies, we are not going to get too much returns. And ultimately, venture capitalists and all investors look for returns. And because of the reality check, many people are now holding back in terms of investing in these companies.
So what should the startups do to convince VC to open their purse strings? And how companies are trying to maneuver this funding winter?
There are three things that smart companies are doing. One is they are cutting down their costs, right? And because of that, their burn rate has come down. And hence the amount of money that they also need on a day-to-day basis or a monthly basis has gone down. So what they're now telling VCs is, hey guys, we become more responsible. And because of that, we don't need that much money, but we need some money, which venture capitalists like. The second thing that they're doing is now many companies are focusing on the term, what is called as unit economics. Now, unit economics is nothing but how much money I'm making per unit of whatever I'm selling. Let's say if it is Swiggy, right? And then the third thing that startups are doing, very interestingly, is now they are getting into alternative sources of funding, right? Many startups don't realize that it's not only venture capitalists that fund, that have funds. There's so many alternative investments. There is debt instruments that you can take from banks, friends, family, and, peer-to-peer lending. There are just so many ways in which you can raise money. And some smart startups have basically gone that route.
At a late stage, startups today need to show a path to profitability and a path to showing that unit economics work for them. I think that is going to be a clincher, and still convincing them that India is a large enough market and they are catering to the right set of customers.
Gaining confidence of the foreign and domestic VCs is important for Indian startups. Experts suggest that it is the survival of the fittest condition, and the survival of startups here is heavily dependent on how well they can adapt to the changing global scenario.
The shares of several new age companies, which include startups like Zomato and Paytm, are on a recovery path, it seems. They have gained 10 to 34% so far in 2023. Moving on, the Q4 earnings season has wrapped up with no major surprises for investors. But since the outlook for some pockets, especially non-banks, remains weak, will India Inc. continue to grapple with an earnings downgrade? Harshita Singhs find out in our next segment.
The March quarter earnings saw sequential improvement as some previously battered sectors like metal, oil and gas, and auto saw profit recovery. The number of companies that beat estimates also exceeded those who posted a negative surprise for the first time since September 2021. The overall net profit rose over 10% year-on-year to notch a record high of nearly 3 trillion rupees, primarily driven by BFSI companies, while the profits of non-BFSI firms fell 4.6% from last year on muted revenues and higher operating and interest costs. Analysts expect the FY24 earnings to lag consensus estimates as India Inc. will see more earnings downgrades, especially in pockets like IT and metals, which remain adversely impacted from a global economic slowdown.
Any export-oriented sectors in India, like the IT sector especially, will see an impact, right? So you will see downgrades happening in the IT sector, maybe in the next couple of quarters. Similarly, your metal sector, which depends a lot on global growth and demand coming from China and the US, will also see downgrades. That we can pivot our portfolios to stay a little bit safe from external linked sectors until unless the situation in the US clears up, right? They're facing a debt ceiling and they're seeing a growth slowdown, and they might in fact see a recession coming in. So we could stay away from sectors that are export oriented or are dependent on the external economy, and we can focus on maybe infrastructure linked sectors in India.
In a note last month, Amish Shah of Bank of America said that Nifty consensus estimates are lofty despite a weak outlook for software firms and could be slashed to 11% and 9% for FY24 and FY25, from 17% and 16% respectively, as against the consensus Nifty EPS estimate of 991 rupees for FY24. Ambit Capital and Kotak Institutional Equities see this as 940 rupees and 913 rupees respectively. Meanwhile, banks, NBFCs are key sectors that will likely stem the weakness in overall earnings ahead, analysts say.
So I think banking and finance, that is NBFCs, this sector should continue to support. It has already supported for the last couple of quarters, and it continue to support because credit demand is very strong. If you go by the verbatim given by various public sector as well as private sector banks, I think if rains do not play a havoc, FMCG should also contribute, and along with that, consumer discretionary like autos, this should do well.
Analysts suggest investors stay away from select pockets like IT and instead raise bets to high beta players like banks. Today, on June 2, equity markets will seek direction from global markets. The crucial jobs data for May will also be eyed in the US.
He's moving from employee to employer. Business Standard.
After markets, let us turn our focus to the banking sector, which was the theme of our first story. RBI Governor Shaktikanta Das has cautioned banks against aggressive growth strategies and the evergreening of loans. But what is this evergreening of loans? Debagyo Sanyal explains.
The RBI Governor's cautionary statements on the evergreening of loans left many listeners with a quizzical look on their faces. Shaktikanta Das had said that several banks were restoring to innovative ways to conceal the status of their loans during supervisory processes, and the evergreening of loans was one of them. The evergreening of loans is a term in which banks try to revive a loan that is on the verge of default by granting further loans to the same borrower. If an account turns into a non-performing asset, banks are required to make higher provisions that will impact their profitability. A loan turns into a non-performing asset or NPA if the interest or installment remains unpaid even after the due date and remains unpaid for a period of more than 90 days. Therefore, to avoid classifying a loan as an NPA, banks often resort to the evergreening of loans. In the past, many banks had indulged in dressing up bad loans and given additional funds to companies who did not have the capacity to repay. Banks delay the recognition of losses due to loan defaults and engage in evergreening, which is essentially the rolling over of debts of unviable borrowers that would have otherwise defaulted. Some banks have even extended such loans to willful defaulters to keep them out of the defaulters' books. This practice put lenders at risk of huge amounts of defaults. Besides, the RBI does not approve of evergreen loans and has set strict norms and potential penalties for banks committing this practice. Banks often resort to evergreening problem accounts under the guise of restructuring. Between 2000 and 2014, corporates were allowed to opt for the liberal restructuring route. This helped companies to use fresh loans from banks to evergreen their loan books. However, with the enactment of the Bankruptcy Code, evergreening has declined. Recovery, nonetheless, has remained abysmally low. Now, with Das's recent caution, it seems evergreening is still going on and, in fact, requires renewed focus from the central bank.
I will achieve, I will fly high. SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
In 2014, Raghuram Rajan, who was then the RBI governor, had ordered an asset quality review, and a host of such concealed bad loans surfaced. That's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
For more news, views and updates, subscribe to Business Standard on Google Podcast, Apple Podcast and Spotify. Also follow us on YouTube, Vimeo, Instagram, Twitter, Facebook and LinkedIn.